and type of investment. You have handled portfolios for
Well, obviously, this all depends on the market and
mindset. Like, how are you dealing with the highs and lows, the successes and failures of juggling so many roles? Hey, DJ, how's it going?
good. Nick, how are you?
Hey, good. Hey, hello everyone. Welcome to the Masters of Real Estate. Today we're going to learn from one of my first mentors in the world of real estate investing, DJ Van Keuren. DJ, I've always been curious about this. I've never had a chance to ask this to you. What does DJ stand for?
Well, my last name is Van Keuren, which is a Dutch name, and DJ. My dad got nicknamed Dutch in college, and so growing up, they just called me DJ for Dutch Junior. My real name is Lauren Van Keuren II.
Lauren Van Keuren II. That sounds like a family office in itself. I will get into that in more detail. So, DJ, how do you introduce yourself to your target audience? How do you?
A family office executive, and that's really the way I position it, or a family office real estate executive.
Wow. So, if you had to summarize your family office career using a single metric, as to how much your wealth have you managed, or how much total value, what is the total value of the investments you have influenced? What would you say that is?
The number in my career has been over $6 billion. But it's when you say influence, I think that's a little different too, because with real estate, sometimes the best deals you do are the ones you don't, because you're making a bad decision. So if you take that into consideration, I mean, that can be a considerable.
Oh, I love that answer, because it doesn't just talk about your wins, but also talks about how you help other family offices preserve wealth, even if you don't help them. So, DJ, let's talk about you're 6 billion today. You've had an amazing career. You're still going to have a rocket ship career from today. But let's go all the way back to zero, when you were not in this space, when you're not doing anything. And what would you say are some of the main inflection points in your life that led you from being relatively new to wealth and asset management to helping influence investments of over $6 billion?
Well, if you look at my career as a whole, in the 90s, I was a financial advisor. I sold that practice in 2000, and I moved to Vietnam, where I had co-developed what today is the largest coffee company, premium coffee company in Vietnam. Came back in 2003, and I was sitting in Saigon, and I was like, what am I going to do now? And I said, real estate. And so I actually came back, and, we were talking a little bit about before, about this also allows you to sort of provide education for yourself. And I don't think I've ever told you this before, but what I did is I read every book I could for 1 year. I did everything from the late night gurus, Carlton Sheets, bought his stuff, listened to his stuff, to when I was taking classes at Harvard in real estate. And what's interesting is that the fundamentals are the same regardless of who's discussing real estate, right? And there's certain things that you look for, you need to be aware of. But once I did that, there was no looking back. Then I went to graduate school at Harvard. And then after that, I started doing some work in the institutional realm, working with Goldman Sachs and Blackstone and Carlyle, and worked for my first real family, which was out of Mumbai, one of the largest developers out of Mumbai, actually. And we were buying luxury hotels and condos in New York City. And then when I moved to Denver, I literally fell into the family office space, which is what 95% of the people that work for a family does. And I fell in there, and I've never looked back. And, I remember I was 45 years old, and I was like, I finally figured out what I wanted to do with my life. And it's real estate and family offices.
Real estate and family offices. We'll get into what family offices are and all that in more detail, but I'm sure listeners want to understand more about you and your personality. So, DJ, what do you feel is the best spirit animal or bird that describes you?
I'll tell you, when I saw that question was coming, and so I I took a quiz online to say, what's your spiritual animal? And it came back as a tiger. So I guess tiger would be my answer.
Now, seems like we have a very similar spirit animal. So, DJ, as a tiger, you're juggling a lot of roles these days, right? You're involved in executive education, you're advisor to family offices, you also are a host of a podcast. First of all, what else are you up to?
Well, the Family Office Real Estate Institute, it carves, there's a fair amount there. There's the quarterly magazine, there's the podcast, we do the largest annual family office real estate investing study in the world. We just started doing an annual conference, and then a couple investment forums a year. And then, so that's one thing. I also write for Forbes about family office real estate investing. I have a newsletter, LinkedIn. We've got about 32,000 people on there, so I'll write there. And I'll speak at various conferences around the world, do podcasts like this. And that's just on that side. And then my main business is Evergreen. And we're a family office real estate consortium where we invest on behalf of families. And we've been working on some great things, specifically a fund structure that doesn't exist in the market. That was specifically created for families, and that's to help maintain their legacy and wealth. And so between all of that, very busy.
Wow. So why? Why are you doing so much?
Well, it all links together. And over the last, I will say over the last year and a half too, I've been an expert witness for a family office, scenario in New York, which I'll be finishing up here soon. But everything ties together. It's the education is very important, and that's actually a way to give back. It's actually, I've been able to influence a number of people that were able to get their governance put in place. And, that I didn't do it personally, but I referred them to the right people, or the legal aspect. So it goes outside of the real estate as well, but that's pretty impactful. So the education is there to provide, what's needed because it's missing. And then, actually implementing and, doing what we talk about and what we preach with Evergreen.
I want to get more into Evergreen and family offices, but mostly I want to understand what's your mindset? Like, how are you dealing with the highs and lows, the successes and failures of, juggling so many roles and doing so many things?
Well, the fortunate thing is what we have all heard probably since we were young is if you love what you do, it's not work. And it's not work. I mean, I absolutely love what I do. Get to meet fantastic people like yourself and, have some fun along the way. And so it's busy work, but it's not difficult work, I guess you could say. And it builds on itself, right? And so it's a step-by-step thing that you just continue to, go one part at a time. Just like if you were to look back with your not really having a lot of real estate knowledge and where you are today, it's significantly different, right? And I know because we've spoken about this and where you are, and it's step by step. And so it's just a matter of doing what I love and continuing to just want to be the best.
I love it. Step by step. Just put one foot in front of the other. I always say whoever's run a marathon or climbed a mountain has always put one foot in front of the other, step by step. So DJ, step by step, what are you driving towards? What's your number one goal this year?
Number one goal this year is to launch that proprietary structure. That's the number one. That's the number one thing. And that's where all the focus is. And then it's a matter of, getting the institute to another level where I can start stepping back. And so that is on the institute side. But with Evergreen, it's launching that and starting to get that going, because then there'll be a lot of growing happening within that business too.
So, and what do you feel is the biggest bottleneck or the challenge you're trying to solve as you go towards your goal of launching a proprietary structure? We'll get into what that is later on.
The biggest challenge is getting everything in place, all the legal documents, making sure that you have to have the right systems and processes in any business if you're going to grow it. so that you can replicate it. And so it's a matter of making sure that you have those in place. And that also includes the accounting and the fund administration, even though we have a number of funds right now, and the accounting and legal and all of that. So it's everything that anybody that has a business has to deal with, especially on the investment side, but never really gets talked about. But it takes a lot of time and efforts in order to do that. And so that's where everything, to the point where it'll be very nice when that's all behind us, and we can just focus on, getting out there and really helping.
Love it. So you mentioned two things so far. I want to get into both of them. The first is family office, and second is Evergreen, your proprietary structure. But let's start with the ABCs of family office. What are family offices for somebody who's never heard the term before or heard the term in random context before? Can you give us a summary in a few minutes?
I can do that, and I'm happy to do that, because over the last number of years, the word family office has really been overutilized. And people, in fact, I wrote an article about this a little while back, which is people are coming out and they're saying, oh, well, this is a family ran business. We're a family office. No, you're not a family. A family office is there for the wealth of a single family. And it's the wealth, it's the legacy. It's having to do with the future generations. And so are there financial components? Yeah, there are. Making sure that investments are being made wisely. But you also have to deal with, maybe bill pays. Could be the work dealing with their jet. It could be making sure that everything's lined up for the second and third generation. It's not a company, it's a family organization, governance and family councils. And so it's really an entity that's there for the family itself on a holistic basis for today's generation and future generations.
So family office is an entity to preserve and protect wealth made by a family.
Yeah, I think that's a good way to put it.
And I've already mentioned before, a typical barrier to being recognized as a family office is over $400 million in assets. Is that still your current belief?
The number is really that I'll usually talk about is 250 million. And so 250 million and above. And it sounds funny, but if somebody has $100 million, they're really just an ultra high net worth family. And somebody that's, just high net worth is really 5 million and below. And there's definitely a place for that, and you can do a lot of planning, but you don't have the level of sophistication that's needed until you get to that 250 mark. And usually families won't have their own internal CIO until they hit about 750 million to $1 billion. And that's just mathematically what it comes out to be and what makes sense. So it's 250 million and above.
Makes sense. And you mentioned two more categories, which I'd love to get into more detail. So, like you say, a high net worth individual is between, less than 25 million, and anywhere in between 25 and 250 is ultra high net worth. What do you feel about those individuals who can't really afford the expertise of, chief investment officer and other professional amenities a family office has access to?
Well, that's where the multifamily offices come in play. And once again, this goes back to similar definition of what I said before, is that a real multifamily office is handling all of what I call the hard side and the soft side. Hard side being the investment component of it, the soft side being the wills, the trusts, the planning, the family governance, the family councils. That's the soft side. And a multifamily office is somebody that would have an advisor that might work with 10 families, 12 families, but they look at it holistically. You have a lot of people today that say they're a multifamily office, and when you dig in, they're only dealing with the investment side. And it's not just the investment side. Sometimes you got to bring in a psychiatrist. Because there's just issues within the family. So that's where some of the ones that, can go into, can work with those multifamily offices. You do want to be careful. And a lot of times what I've seen too is that a lot of the ultra high net worth, once they hit about 100 million, they go away from investing with the Deutsche Banks or the UBSs or the Meros, and they start going more into private type of investments.
Makes sense. So you mentioned one misconception about family office, which is, it's not only about wealth management, it's also about the soft side. What are some of the other misconceptions about family offices? Like, what are some things that, your listeners don't really understand about family office they should?
Well, I'll tell you the biggest issue, the biggest thing, misconceptions is the same mistake I made in the first 3 months. You meet somebody who's been successful and you're like, this person knows everything. I mean, they've made a lot of money. They're they're smart. They've maybe built a business. They're intelligent, obviously, so they understand everything. Well, the reality is, no, they don't, because maybe they spent the last 40 years dealing in timber or dealing in chemicals or dealing in tires. Now, if you were to ask them about chemicals, they're going to start talking right away, right? Whatever that industry is that they made their wealth, they know inside and out, but they don't understand hedge funds and real estate and venture capital and private equity and, the market specifically. And when you think about it, I mean, people spend their whole life not only in just VC, but VC healthcare, not just VC healthcare, but VC healthcare middle market, and not just middle market, but certain EBITDAs, right? So if somebody's spending their whole life in one little area, there's no way they're going to understand everything. And so, the misconception is that you can start just talking away with somebody that is ultra wealthy. But you have to take into consideration that there may be things you're saying that they don't understand. And so you need to be aware of that.
That makes a lot of sense, DJ. So let's say somebody just had a $250 million liquidity event, which is the perfect number to be able to call DJ and say, now I'm a real. So they call you and say, oh, I just had a liquidity event. What advice would you give?
Well, the first thing I would say is you need to make sure that you build the foundation just like a piece of real estate. And I would direct them to, some of the top industry experts in the legal field and the consulting field, whereas make sure that you have governance put in place. Make sure you go through and understand about a family council, put an investment policy statement together, meet with a real attorney that's worked with a lot of very wealthy families to help you. Because there's a difference in planning when you have 250 million compared to 2.5 million. There's a lot of major differences, and there's a lot of things that you can do, and they're more complicated, quite honestly. So that's the first thing that I would say, is to get your foundation in order. Make sure that you have that and an understanding, and bring the family together so that you guys are on the same page before you start getting into any of the investments.
Makes sense. So once they've built a foundation, they want to start investing. So, they will learn about portfolio theory and asset classes from somebody, but let's teach it to our listeners in a summary. So, according to you, what are the main asset classes that one can invest that amount of capital in?
Well, I tell you how I go about it, first off, but the main asset classes is real estate is one of them, which I'm biased, obviously, which I absolutely love. And from our annual study, the average allocation by a family is about 24%. You also have cash, money that's going to be there in cash, some fixed income, some equities, maybe some alternative assets. The average portfolio return for a family is about 7%.
7%.
So, yeah, and when you work for a family, you're told three things, and it's the same every time, which is don't lose money, don't lose money, don't lose money. Which makes sense because you may never have that type of wealth creation ever again. And so you want to make sure you're smart about it. So be diversified like that. And then what I would do personally is if I wanted to invest in an area, I would go out and find somebody that created their wealth specifically in that area and ask if I could invest with them, because they've already been successful. They know it inside and out. They've got their own money in there and probably a considerable amount of money. And then I'd say, look, can I invest next to you? And to me, that's the way I would go about it, because the one thing that It's no wonder why the rich get richer. It's because of the opportunities that you're provided, which you only have when you have a significant amount of money
That makes
and
sense.
the people.
So for someone listening to 7% a year, that's a lot of people who made their money suddenly feel that they have some sort of a mid-ass touch and they'll be able to keep growing wealth that way. So how do you explain the rationale of like 7% a year being a reasonable long-term compounding target for family?
I think it's a matter of who is it that you're talking with, right? Because if you're talking to the patriarch or the matriarch and they made their money in real estate, for example, they're probably going to be very heavily weighted in real estate because that's what they know. They've been getting a 20-30% return. Why would I go anywhere else when I understand it, right? So that's understandable why a lot of times it's weighted heavily with that first gen. It's the second and third gens that didn't have that experience or didn't understand how to create that type of wealth or didn't create the wealth. And that's where that diversification and spreading it across and not being as aggressive because they're like, let's not lose this, you know? And so there's a different mental picture that's, the way that things are looked at, depending upon the generation.
Yeah, each generation has their own perspective on returns and type of investment. You've handled portfolios for a lot of families. Some listed on your public domain include the Heyman family, which apparently is related to the Giorgio perfume and the Giorgio Beverly Hills, the Arsenault family, which is related to Mountain High yogurt, and a certain family who is related to an owner of an MLB team.
Correct.
If you think about these three families, like how did their portfolio allocations differ from each other?
Well, there's three different, there's five different types of families when it comes to real estate. And from what we mentioned, there's really three of those are being represented. The first family I worked for is the Arsenal Family Office, the most analytical, smartest real estate investor I have ever met. He sold that company for about $1.5 million for Mountain High Yogurt. And I believe he signed the $1 billion pledge a couple years ago. He made his money in real estate, and that's where the majority of his money is. Now, he also invests in oil and gas. He has three people actively trading equities. He's got 6 or 7 solar farms and other investments as well. But his philosophy was based upon market cycles and buying when there's discounts and opportunities and then selling. So it's a matter of buy, fix it up, or build it up, get it cash flowing, and sell, not holding long term. When you look at the Arsenal family, their portfolio, because it wasn't created in real estate was a secondary component of it. I actually had worked with the family member there, and we created was the first boutique office brand strategy that's doing very well today. And that's been more of a buy and hold type of a deal. He has somebody that's full-time that's doing the asset management for those, but it's a portfolio of 12, 14, 15 that they're just buying and holding. And it's the majority of the family's wealth that's been invested into these various properties. And then the family member of the owner was more like the real estate was a lot local real estate, either bringing in some other families to invest maybe on some things, or actually investing with other families or experienced operators, and smaller deals and just trying to maximize the monies and where it was being invested into. So 3 different areas. They're 3, and they're not one of them's wrong, and not one of them is the way that you go. But it's just 3 different philosophies. But once again, it's either somebody that made their money in real estate, somebody that wanted to build up their own real estate portfolio, and another person that wants to diversify with their investments, and real estate is one of those diversifications.
Yeah, that makes a lot of sense. 3 different philosophies indeed, but everyone has their own way of building it. So if you yourself suddenly, let's just use a round number, had $100 million in liquid cash and nothing else, how would you personally invest?
Well, I mean, I would, my first area would be real estate. So that would be the first area that I'd go to. I think that there's a lot of discounts that are coming up around the corner, that some significant wealth will be made with some of these investments that people will have available to them in real estate. And so I would take at least probably 75, 80% of that money, go directly into real estate. And I'd probably take the rest of the money and contact some of the families I know and ask them, like I said before, is can I invest next to you with what you're doing? And that's where I diversify the rest of that money.
I love it. So let's do a quiz. I'll go through different sub-asset classes in real estate, and you tell me whether you would, of that 75 out of 100, you would buy, you would hold, or you would sell. So let's start with single family.
So buy, hold, or sell is what you're saying. Well, obviously, this all depends on the market and where they're at in the market and stuff like that.
So today, today, yeah.
Okay, so single family, that's what I started with in 2003, and to position to be the first single family REIT. I probably wouldn't do that, so I probably wouldn't go into single family. Multifamily, haven't touched in 5-6 years. That is where a lot of money is going to be made. So multifamily would be yes. No new construction. It would be some of those that are going to be running into problems due to the financing.
So single family hold, multifamily buy, right?
Yeah, multifamily buy, single family no.
So just sell or hold?
I'm sorry?
Would you sell single family? Would you hold single family?
Oh, if I had it, I'd hold it.
Hold it.
Because the demand is pretty significant still. You still have a significant rental demand that's out there. So if I owned it already, I would hold it.
Hold it.
Multifamily, I would hold and buy.
Office,
if it was in downtown, I'd probably sell. If it was on the outskirts in the suburbs, I'd probably try to hold on to it. Industrial, I would hold it for sure and buy. And I'd specifically look to buy cold storage, small bay, or industrial, like outside parking.
Explain cold storage, small bay, and outside parking.
Yeah. So small bay is where you've got, they're usually near the city center. And it's where companies might keep storage of 5,000 to 20,000 square feet. So let's say that you had somebody that provided furniture to show houses. Well, they have to store their furniture somewhere. So that would be a place where they would store the furniture, right? Or maybe it's a company that sells, T-shirts. Well, that's going to be a place where they can store those T-shirts. And so that's small bay. And 70% of that is owned by local mom and pops. So there's a great roll-up opportunity for that. In commercial or in cold storage, the demand strongly outweighs the what's available in the market. And then the parking, I mean, it's just more of a new type of storage. Outdoor storage is what it is. And there's been more and more demand, especially for like trucks as they're, commuting and carrying supplies in different areas.
Fascinating. Let's go on to the next asset class, retail. Do you buy, hold, or?
You know what? I would hold or buy. There are very, very favorable, when you look at retail and where they are and what's happening, it's actually a very favorable area to invest in.
What about hospitality, hotels?
I would buy, but it'd have to be, if I did, it would be like the business hotels. It wouldn't be the conference ones that have conferences. It would be those that are, like a Fairfield Inn type of.
Fascinating. What about land?
Land, I would not buy right now because land's what drives everything. And when you start going into a recession is when that land price is really going to come down. And when that land price comes down, that's where you'll make a lot of money.
What about
mixed use?
Yeah, mixed use.
Yeah.
And define what mixed use is for somebody who has never heard of it before.
Yeah, so a good example of mixed use is where you have apartments on everything but the first level. And on the first level, maybe you have retail stores. You have the Starbucks down there, maybe a supermarket. And so there's more use than just one type of property type. So that's a good example of it. I think that can go hand in hand. I would buy and hold for that. because it's typically part of a multifamily component too.
Makes sense. What about self storage?
Self storage, I still think there's some upside with self storage. So I'd buy, might even build on that for sure, hold. And then, yeah.
Okay, let's move on. What if you were forced to put all the capital in just a single thesis in real estate?
I'd probably go, I'd put it into workforce housing, and I would put it specifically into a concept that we've already invested into in Texas, which is because the demand is so significant. And it's just a fantastic business model that's sort of ahead of the curve a little bit. And so if I had to do that, but it's considered workforce housing, and that's where I'd put the money.
And how would you wrap it in your proprietary structure? Can you explain to the audience how your proprietary long-term, wealth protection structure works?
Yeah. So basically, 70% of families lose their wealth by the second gen and 90% by the third generation. And so one of the best ways in order for people to maintain that wealth is through real estate, because you have all these tax benefits and you have all these flow throughs that can benefit you today. It's not going anywhere, and historically it's continued to go up. And it's even proven that when you hold on real estate long term, you're often better off than if you just keep buying and selling. And so one of the benefits that the IRS provides is the 1031 exchange, where you can defer your taxes. And so instead of paying Uncle Sam, you reinvest that money into additional properties. And you also take advantage of compounding interest, which is just keeps accumulating as well. So our structure takes advantage of that. And so it allows for a diversified portfolio to have a continual 1031 exchange into properties once they obtain their value, whether you build an apartment or you lease up the apartment or the industrial building and then you sell it, you reinvest it right back in to the next deal. And so you have that compounding effects. And that can go on for generations and generations.
And explain to the audience, what would happen once the holder of all these assets passes away. How would it be treated in inheritance? Because there is an inheritance tax for assets over 10, 11 million or something in that range, I believe, right?
Yeah, well, there's a couple different things that you can do with this structure. One is you can actually start to move assets outside the estate. And so there's a mechanism that we have where you can actually move it out of your estate. And so it's passing over to the next gen without having to worry about any taxes, because it'll continue to grow, right, in their name. And that's on a go-forward basis. So that's one way. Secondly, there's a step-up basis at death. And so that's the other way that there's a beneficial as well. And then we can also use the same structure where if somebody has a low basis on their property, but they have all this equity in there and they want to unlock the equity, we can actually structure this in a way where they're able to pull out their equity, where they can invest into other different areas without worrying about that low basis, but continue to make money.
At this point, I have to remind listeners that neither DJ and I are tax advisors. We are not tax advisors. You should consult a tax professional. We're just talking about a hypothetical scenario in which how DJ would invest his own money. So DJ, let's say you just made $100 million. You're putting it all behind workforce housing, behind this concept in Texas that you really liked, and a similar concept like that. You're putting it in your Evergreen structure, which allows you to keep rolling your capital gains and keep deferring them till you die. And then after that, you would pass it on to the next generation on a step-up basis. What does that exactly mean, step-up basis?
That means that, let's say that somebody invested $5 million. Let's say that grew to $100 million at the time that the matriarch died, and you made $95 million. Well, instead of pay taxes on that $95 million, step-up means that you start with a basis of $100 million, what that is today when that person dies. You don't go all the way back to when it was $5 million. So you're not going to pay tax on that $95 million that was made. And now that's where you started at. So now you're going to pay taxes on what's over $100 million, but nothing from before.
That's amazing. This is probably one of the only major capital gains tax saving strategies out there. And I'm very, very proud of you, DJ, that you're launching an entire structure and creating a proprietary thesis on this so families can take advantage of this. So, suddenly if our listener, has made $250 million, under that, don't call DJ. You're too poor for him. But if you've made over $250 million, DJ, how should they reach out to you, and how do you want them to contact you?
Yeah, so there's a couple different ways. One, they could always reach me through you. That's one of them. Two, you can Google my name. I'll come up. You can go to djvankeuren.com. You can go to evergreenpropertypartners.com. And or you can find me on LinkedIn and just send me a note. But those are the easiest ways that you can find me. And if you happen to run across a Family Office Real Estate Institute, which is FORE.institute, not .com, but .institute, you can find me there as well.
And we'll add the links in the description down below. So DJ, now switch conversation, and most of the audience is probably not going to be ultra and high net worth individual. They're probably going to be somebody who's been curious about family offices and wants to possibly raise money from. As someone who has helped families in dollars, sitting on your side of the table, what do you see as the most common mistake that sponsors or managers make when they try to raise our capital?
Yeah, so the first one is what I brought up before, which is don't assume that they understand everything. Because they are, yes, they're brilliant people, but they've also been in a different industry forever. So make sure that you're focused on the the fundamentals, and also explain why you're investing into something. We're investing into this because of this, or here's the opportunity that's out there, and this is how we're taking advantage of that opportunity. So that would be the first one. Second thing is, don't look at family offices as a checkbook. Too many people just come up, and Nick, I'm sure you've had this before. They're like, "Hey, give me $10 million," and you're like, "Okay, yeah, what's your name? Let me just write it out." It's a relationship based, and you got to build a relationship, and it can take a while. That doesn't mean you won't get an investment in the next 30 days, but you also might not get one in the next 10 years. But then, and then also families, a lot of times will start out small, whether it's 200,000 or 2 million, but the next check could be 2 million and 10 million. So they want to get to know you and who you are. And people say all the time that families are like institutions. They're not. They're more like the retail investor. The retail investor, it's their own money. They're making their own decision. Whereas on the institution side, that's not their money. They're investing on behalf of other people. They have no emotions. If they lose the money, quite honestly, maybe they lose their job, but it's not like they're losing the actual money. So find out more from that perspective, and then also be sensitive to issues that they may have going on within their family because of what wealth can be thrown into the mix, right? You could have family issues that are going on. There could be, dynamics that are happening where one family member wants to invest over here, another family member into something over here, and they don't have that, understanding of how they're going to do that. So I think you need to be more compassionate about that. There's more to it with families, and build that relationship.
Completely agree. And zooming out and seeing the future, what problem do you want to see solved in the family office industry that hasn't been properly solved?
It comes down to, as much as it comes down to the biggest problem. We're gonna have one of the greatest wealth transfers in history, and today it's about $10 trillion, $12 trillion. Over the next 10 to 20 years, that's going to grow to 60, $70 trillion. And with that money, a lot of foundations, a lot of good can come of that, and that's the one thing I think that gets overlooked, that there's a lot of good that's been done and money that's been put into great areas. But the biggest risk is the statistics that I mentioned, where 70% lose their wealth by the second gen and 90% by the third gen. And so it's solving that problem. And a lot of that has to do with planning, communication, and understanding. And so that's the biggest thing that needs to be addressed and continued focused on.
I love it, DJ. You're so thoughtful about all these things. Now let's move on to rapid fire. Three short questions, three quick answers. You mentioned you're on a podcast, DJ. What is the most counterintuitive insight you've gained from your guests?
Counterintuitive. Um, in what manner? When you say counterintuitive, you mean like the biggest thing I've got from them?
That you
The
weren't
biggest,
expecting to learn. Yeah.
okay, the biggest thing I've learned, quite honestly, has come from not only guests, but also working for these families. And that is you surround yourself with great people, but at the end of the day, you bet on yourself. All the very successful people have a lot of money. If they're going to lose, it's because of themselves. But if they're going to win and I got to bet on somebody, I'm betting first and foremost. So that's what I would say.
Love it. And what is the number one mistake you see your peers or other people making in this industry?
Understanding, I would say, understanding the importance of relationships and that it takes time to build those relationships with these families and these people. And you need to be patient.
Be patient. It takes time to build relationships. Agree. If your loved ones agree to be mentored by you, what's the most important or the number one life skill you would teach?
That's a very good question. There's been somebody that I've gotten to know over the last year or so, very, very, very successful gentleman. And I was watching him with his up on stage a couple days ago with his daughter, and it's really sent home to me. I think it's for my kids would be to be a good person, do the best you can, and one thing I've preached from day one is you need to do something that you really love because life's too short, and you don't want to wake up one day and you're still doing something that you don't like. But if you find something that you enjoy, you'll be good at it. If you're good at it, you're going to want to do it more. And if you do it more, you'll be even better at it, which will make you want to do more of it. And it'll just go perpetually. So do something that you enjoy to do is probably the biggest thing.
Perfect. Thanks, DJ. So that was DJ Van Keuren. If you suddenly come across $250 million and need help in investing, reach out to him on djvankeuren.com and we'll drop other links in the description. If you want to talk about real estate, specifically residential real estate focused on single family, shoot me a note anytime on nick@home.com.